Hello and welcome to another episode of The Future Of. I am Azam Faruqi, and we have a very, very good guest today with us. The topic of our conversation today is future of investing. So we have today Professor Steve Foerster, who is the author of this book, In Pursuit of the Perfect Portfolio, right here, which he co-wrote with Andrew Lowe at MIT. He is also the professor of finance at Ivey Business School. And we're very glad to have Professor Foerster with us today. Thank you for your time, Professor.
Hi, Anthony. Great to be here.
Thank you. So why don't we start? So investing is an interesting discussion. There are a lot of facets to it. But before I actually even get into a conversation, just for the benefit of our viewers and listeners, any discussion we have today is only for educational and entertainment purposes. We are not soliciting any investment or financial advice. Please speak to your professional. And the Future of podcasts and Professor Foerster are not responsible for any decisions that you make based on after our conversation today. So, Professor Foerster, I want to start off with a little bit about background and history of finance, right? Or history of investing. It's sort of like correlated, I guess. And I know in your book, you started off with some background, and I sort of it in two parts. One is it like probably all the way from the beginning until the end of the 19th century, and then moving into the early part of the 20th century. So if you mind walking us through that, please.
Sure. I'll just give you some highlights, or else we'd be here all afternoon. There's a long history of investing in various facets. The first personal loan that was recorded goes back to 2400 BCE, based on some Sumerian records. Derivative contracts, which we think of as perhaps a more modern concept, in fact, dates back to 1900 BCE. When we talk about loans, there was actually a loan that was recorded in around 1800 BCE at a 5-year rate of 3.8%. And what's fascinating about this particular loan is there was actually a secondary market for it. So again, we think of liquid traded securities as being more modern, and yet this goes back centuries and centuries. Endowment funds go back to at least the 3rd century BCE, and some of them even had a tax angle to them, where wealthy donors could limit their tax liabilities by sheltering some real estate. Government bonds, the precursor to government bonds is a fascinating story that dates to around 1172 in Venice, when Venice was in a struggle with Byzantium, and they were fighting over control of the Adriatic Sea. And so what happened is that there were fabricated charges that the Venetians had set fire to a neighborhood in Constantinople. And so the Emperor Byzantium then created a hostage crisis by seizing some Venetian merchants. And so the Doge, or the chief magistrate of Venice, had to try and rescue these hostages. And so he needed to quickly build a fleet of ships in order to wage war. But given the religious laws at the time, he couldn't borrow money and pay interest. So he found a clever way around this by creating what was known as a prestito, which was a mandatory tax that promised to pay 5% interest until the debt was retired. So effectively, it was like a loan. And so this was the precursor to government bonds. Now, the story didn't end well for the chief magistrate. It turned out that the Venetian fleet was suddenly ravaged by plague, and thousands died, although the chief magistrate survived when a mob chased him, found out that he had lived. They chased him and executed him. So it didn't end well, but the idea of a government bond did survive. And in fact, the first government bonds date back to the 1500s in Amsterdam. And what's interesting is one of the oldest perpetual bonds that pay interest theoretically forever was issued in 1648, and Yale University actually is one of the five current bondholders. So this is 374 years later, and Yale University is still receiving. It's around $13 per year. Not a lot of money, but speaks to the history of these types of investments. Just a couple more things in terms of the history. The oldest shareholding company dates back to 1369. It was a group of French millers, and what was innovative was that they elected a board of directors to protect shareholders, so the precursor of the modern directors as overseers. And the interesting wrinkle here was that there was a stipulation that any new shareholder had to host a dinner party for the entire board of directors. Actual stock companies or so-called joint stock companies, the first modern stock companies are the well-known British East India Company and Dutch East India Company that date back to 1600. And the first mutual fund dates back to 1774 in Amsterdam, followed a few years later by what really would be the first value investing fund. It was looking for buying securities that had a decline in their prices below their intrinsic value. So some fascinating history to where we are now.
Wonderful, thank you. And so that takes us to until the end of, let's say, the 19th century. Then we have the early part of the 20th century, and there are a lot of things happening around that time. John Maynard Keynes was one of the big economists of that time, probably arguably one of the three most influential economists of all time in terms of his influence that it still exists until today. So he wrote a lot about investing. He was a personal investor as well, and I think you wrote a little bit about him. And Irving Fisher was the other one, I believe. And they kind of had some contrasting styles. Fisher had some bad luck with investing from time to time.
Yes, absolutely. So what was happening in the 20th century is this is where we start to see a shift from what might be referred to as the art of investing to the precursor to the science of investing, which is where our book picks up with Harry Markowitz and others around the 1950s that I'm sure we'll chat about. But there were a number of academic related books by, as you said, John Maynard Keynes, his famous The General Theory of Employment, Interest, and Money in 1936, and predating that, Irving Fisher's The Theory of Interest in 1930. And Fisher, you may know, and others may know, from the well-known Fisher equation that equates real interest rates to nominal rates less inflation. So these were very important and influential books. Unfortunately for Fisher, a lot of his great works have become overshadowed by an infamous proclamation that he made in October 1929, where he observed that the stock market had reached a permanently high plateau, and this was just days before the crash of in October 1929, the major crash in the stock market, which led to the Great Depression. So, unfortunately, that tarnished his reputation. In terms of Keynes, in the general theory, there wasn't a lot that was in that document, which became a real primer for central banks. But there wasn't a lot in that document in terms of investing. And in fact, he likened the stock market to a beauty contest, and he attributed price fluctuations to what he called animal spirits. But Keynes, as an investor, actually performed spectacularly well. He managed the endowment fund of King's College between 1921 and his death in 1946. and his performance relative to an overall market performance was exceptional. It was recently estimated that his average annual returns that he was able to obtain for the endowment fund was 14.4% per year versus 9% for the overall market. And what's also fascinating is that around 1933, he famously changed investment styles from sort of a top down to a bottom up, becoming more of a value investor, and so he did even better in the latter part of managing the fund and overseeing the fund with average returns of close to 18%. So as great as Keynes was as an investor, he really didn't leave a legacy and a roadmap in terms of investing, and so that was left for others that were to follow in the mid-20th century.
Yeah, and I always find it fascinating because this is sort of like the prequel to the development of finance, where finance itself was subset of economics, more or less, right? Like mostly it was the economists working on it. But I always find Fisher as a bit of a tragic hero, like, sort of, because even Keynes was wiped out in the Great Depression. It's just how they reacted after the fact, like you said, that he moved more towards a bottom-up approach, allowed him to rebound quickly. So anyone who ever is interested in history of finance, it's actually a very interesting tale if you want to go down that rabbit hole. So then we move on. Finance starts developing as a field on its own. We have economists like Samuelson and all these great individuals coming across. But then this guy comes across, Harry Markowitz, and he talks about portfolio selection, and that sort of flips the investing world upside down. And this is where you start off in your book when it comes to the pursuit of perfect portfolio, because he started putting some scientific theories around them. So what was so great about Markowitz?
Yeah, absolutely. So this goes back to a seminal paper that he wrote, and in fact, we're almost precisely 70 years after the article was written back in March of 1952. And it was an amazing article because it was so different from other articles. It was in what we still call a top tier finance journal, the Journal of Finance. But it was unlike almost any other paper that had been published there. What seems obvious now was really a revelation 70 years ago. And what Harry Markowitz was able to show in a mathematically rigorous manner is that what matters when it comes to risk and return is how security prices vary relative to one another. And so he really created this process and a framework and a discipline to analyze stocks as a portfolio rather than just as individual investments, which had been the common wisdom up to that point. And in fact, what he was able to show is that there is a free lunch. You can get a free lunch, and by that we mean you can improve your return to risk trade-off by forming a portfolio of stocks. And so he created what became known as the efficient frontier. And so his framework was simply looking at expected return. So imagine in a two-dimensional space, and imagine on the vertical axis expected returns for individual securities, and imagine on the horizontal axis a measure of risk, and think of risk as the variability of returns. And so what Markowitz was able to show is that if you had some information in terms of what your expected return was for each individual security, what your expected risk level, as we would think of it as now, as a standard deviation of expected returns or risk, and most importantly, how securities correlated relative to one another. And so here's where the magic comes into play. By forming a portfolio of securities, we can get closer to the northwest corner of that graph that I'm describing, with expected returns on the vertical axis and risk on the horizontal axis. And so that's the beauty of diversification. And so this efficient frontier, what he was able to show is that among all individual securities that one would be considering, they were dominated by a series of portfolios, a series of risky portfolios that had the common element that they had the highest expected return for a given level of risk, or another way of saying it, they had the least amount of risk for a given level of expected return. And so what he was able to show is that this was dominant. You want to have this diversified portfolio. Don't put all your eggs in one basket, which might have been common wisdom, but he was able to create a model to show this, and ultimately ended up being a recipient of the Nobel Prize in Economics.
Awesome. And how was his work taken when it first came out? Because this was totally new at that time, right? How did the world of finance or economics react to it?
So, and these things often take time, and can take even decades. It was taken, I think, more of a theory, and the practical implications weren't perhaps as obvious. It was really this classic model that is still used today, but it's a classic model of where an individual investor is trying to maximize utility or maximize their expected return, subject to a number of constraints, and the major constraint being the desired level of risk that you have. And what was important is that Markowitz viewed this not as a static model, but as you get more information, then you update your beliefs. Now, where the practical challenges came in is that there were emerging computing power, but it was very primitive. So to try to actually take these inputs and create what might be the ideal portfolio would be almost prohibitively expensive. And so I think this is where it was initially viewed as something that was very interesting as a concept, but the practical implications weren't obvious.
Wonderful. And I guess one of the things I really liked, and this is a recurring theme amongst all individuals that you covered, is how human beings assess risk in general, right? And how do we define risk? And obviously, there's a whole other conversation about how, in general, like with the pandemic and stuff, how we've come to a certain risk. But the one thing that he did talk about was the implications of mean variance analysis as a rational approach to decision making under uncertainty. Can you expand what he meant by that?
Sure. So this is really critical to these models, and this gets into some of the other luminaries that we discuss in our book. But this model that I described in terms of maximizing utility subject to constraints, the key underlying assumption is that all individuals, or in this case, all investors, are rational. And so all they care about really is, I want higher expected return, all else equal. I want less risk as defined by variability returns, all else equal. So the way I like to think about this is to what's really built into this model is, for any Star Trek fans out there, all investors act like Mr. Spock according to this model. They're all rational. They don't show any emotions whatsoever. And really, one of the luminaries we interviewed in the book, Gene Fama, also a Nobel laureate, really this is his starting point for his famous efficient markets hypothesis that postulates that securities fully and immediately reflect all relevant information. So underlying that is that all investors are rational. But what if all investors aren't rational? And what's interesting is that this is actually the perspective that's taken by another of the luminaries that we interview, also Nobel Prize winner and co-recipient, ironically, in the same year as Gene Fama, and that's Bob Shiller that I'm referring to. He's what's known as a behavioral economist, and his view of the world is that not all individuals are rational. Unlike Mr. Spock, some investors might be more like Homer Simpson, for example, and those are my words and not Bob Schiller's words. But so this is a very different perspective, and so who you believe, is it the Fama camp of the rational investors, or is it the Schiller camp of the irrational investors, or at least not all investors being rational? That's going to have implications in terms of your particular investing style.
Wonderful. And I guess one of the things about Markowitz's work, which is like any other scientific subject, whether it's economics or hard sciences, it allows the future giants to build on that work, right? So continue
Absolutely.
that work. And the next individual that features in your book is Bill Sharp, and he's known for a lot of other things. One of them being the development of the CAPM model. I believe he preferred to still call it CAPM model.
That's correct. Yes.
And that sort of helped develop indexed investing somewhat as well, right? Like there was some
absolutely.
So how did Sharp take the conversation forward?
Sure. So Bill Sharp was a protege of Harry Markowitz. In fact, he was introduced to Harry Markowitz because of a failed first attempt at a PhD thesis in what he thought was a great topic, which was transfer pricing, and it didn't work out. And so his advisor introduced him to Harry Markowitz, who had made a presentation at UCLA where Sharp was, and so they got to know one another and ended up becoming collaborators and friends over the years to this day. So basically, where Bill Sharp started is where Harry Markowitz left off, which is with the sufficient frontier idea. And recall what Harry Markowitz's contribution was, that of the set of all securities, all you have to care about are these various portfolios that are on the sufficient frontier, which we can think of it as sort of a curved line, if you will, in this expected return on risk space. Bill Sharp introduced one additional assumption. What if we could borrow and lend at a risk-free rate? How does that change the whole equation? When you introduce that, and this is the beginning of what you refer to as the capital asset pricing model, or the CAPM as Sharp refers to it, what you get here is that it turns out, both graphically and mathematically, that among all of Markowitz's risky portfolios, there's only one that is the optimal portfolio. And it turns out graphically that's the tangent line between a risk-free security and the sufficient frontier. And the magic of that particular tangent portfolio is that according to Bill Sharp's capital asset pricing model, all investors would want to invest in that particular portfolio and only that particular portfolio. Now, depending on your risk preferences versus mine, you might be more risk averse than me, and so part of your portfolio might be investing in risk-free assets, part might be in this risky market portfolio. I might even borrow and take on even more risk. But what we have in common is we're both investing in the market portfolio. So the next part of what Sharp was able to show is how each individual security that's part of the market portfolio gets priced. And this is his capital asset pricing model, which shows that the only thing that matters from a risk perspective, assuming I'm holding this diversified portfolio, is the risk relative to the overall market portfolio. And this became famously known as beta. And so it doesn't matter how risky, if I were to own that security individually, how much of a standard deviation of returns I would get, because that doesn't matter if I'm going to be well diversified. And so all that matters is the relative riskiness. And so the key implication was that you should hold only one risky portfolio, and that should be the market portfolio. And Sharpe knew in 1964 when he came up with this model. He knew that this was probably his best work, and he was right. And he was waiting for the phone to ring for practitioners to come on board, and for the next decade, nothing happened. It wasn't until Jack Bogle, who is another luminary who we interviewed, founder of the Vanguard Group, it wasn't until Jack Bogle that came along and created these mutual fund index products that was the beginning of this index investing revolution. And even that took decades to really gain some steam.
So let's talk a little bit before that, because I do want to get into indexed investing. But before I do that, I want to go back. Again, there are a lot of really good quotes in the book, especially when you read the perfect portfolio piece for each individual. And one of the things Sharpe said was diversify, economize, personalize, contextualize when building a perfect portfolio. What did he mean by that?
Sure. So let's take each of those one by one. For the first part, he followed it up by saying, diversify, diversify, diversify. So he couldn't emphasize that enough. And that really goes back to the capital asset pricing model. So what he's saying there is buy the market portfolio. What's fascinating, actually, we often think of the market in a U.S. context to be something like the S&P 500 index. But theoretically, what Sharpe meant was all assets in the world, investable, non-investable, really that's at the center of it. So it's stocks, bonds, real estate, everything you can think of is part of that portfolio. So diversify broadly. By economize, he was really referring to minimizing costs. Avoid unnecessary expenses in terms of management fees and trading costs. And many of our luminaries emphasize this whole point of minimizing costs, including Jack Bogle, who had a takeoff of the efficient market hypothesis, and he called it the cost matters hypothesis, basically saying that you want to minimize your costs, and if you're not buying an index fund, then on average your portfolio is going to be reduced by the average costs from this active investing. The third part in terms of Sharpe's saying was to personalize, and by that what he meant was to take into account anything that might be unique to your situation. For example, the industry that you work in. So if you're working, let's say, in the tech industry, you might actually want to not invest as heavily in the tech industry, because if things go sour in the tech industry, not only will you lose money on your investment, but you might lose your job. His final point was contextualize. One thing that he wants us to keep in mind is that if you're betting against the market, if you think the market isn't efficiently priced, then that implies you think everybody else is wrong. And so while that may be the case, it also might be quite rare. So you have to be able to justify why you're right and why the market is wrong. And so put it in this context in terms of how prices are formed. A lot of intelligent, informed investors who have done a lot of homework have come to the marketplace to create the prices that we see.
Wonderful. And then you've already mentioned Jack Bogle. He had a massive influence. He's probably one of the few non-academics who's probably taken this whole theories forward and has really made it very successful. Passed away a few years ago. What do you think is the impact of Vanguard and value investing overall? If you take a step back over 70 years, if you're talking about especially democratizing investment and investing in a way that it allows a lot more people to be more like a do-it-yourself investor rather than relying on portfolio managers. The fact that an index more often than not can beat a lot of portfolio managers, right? So, can you talk a little bit about that?
Sure. I think he has really helped to drive down trading costs, and if not for Jack Bogle and Vanguard, investors would have had to incur billions, if not tens of billions of dollars each year in higher fees than we see now, to the point now where there are many trading accounts that one can open that is as close to commission-free as one could get, versus years ago where costs were quite high, several percent just to trade in one stock.
Awesome. So when we talk about this index investing or passive investing, the other thing that goes hand in hand is active investing, right? So yes, cost is one factor, but can you elaborate what is the actual difference between an active investment? So let's say if someone listening hasn't really invested a lot themselves, so what is active investment versus what is passive investing? I think it's probably helpful to just have a definition. And what are the pros and cons of the two approaches?
Sure. So by passive investing, we're not trying to beat the market. We're trying to match the market. So passive is relative. The context is that it's relative to a benchmark, again, such as the S&P 500 index. So a classic passive index is one that tries to provide a return very close to the return that you would get by investing in all of the 500 stocks that make up the S&P 500 index. The big benefit of that is lower costs, and also you have tremendous diversification benefits. Unlike active investing and an active fund, which will probably have much fewer securities, and trying to pick what will be the winners. By nature, active investing is more costly. So now we have to hire good managers and give them the resources to try to find out what securities they think are going to be undervalued. There's an opportunity for huge gains that are much greater than the overall index. And so that's the upside of active investing. Of course, the downside is that on average, for every winner, there's going to be a loser. And so you could end up underperforming relative to the overall market. And to the extent that there are costs involved, it's going to make it that much harder to beat the market on an after fee basis.
Awesome. So before we jump on to the next question, I just want to ask a little bit about, because obviously we can't go through every figure and mention in the book. One, we don't want to give everything away, and secondly, I think it's going to take a lot more than just a regular slated hour. What's the impact Bob Shiller's had in the world of finance? So, I mean, obviously, with Kahneman and Tversky, we saw the development in behavioral economics, and then individuals like Richard Thaler, also who won the Nobel Prize, they took it further, and we're starting to see a lot of input from behavioral economists in a lot of different models, right? And I think it does make sense to see that man is not always rational, right? So we can't always base on rational decisions. How important has behavioral finance be, and where is it at today relative to the rest of the field of finance?
So it's made great strides, and this goes back at least to, as you say, Kahneman and Tversky, well-known economists, well-known psychologists who actually had an impact on economics, and they came up with a model they called prospect theory back in the 1970s. And so it's taken a while, but I think it's fair to say that today, decades later, behavioral finance has become more mainstream. So we do recognize that these models, these rational models, have their limitations, and so some of the implications are that while it's clear that in a rational world, passive investing makes sense, I think with the advent of behavioral finance, it suggests that there may be opportunities in terms of active investing strategies. Doesn't mean that it's going to be easy, but there's room for it. There still are if you ask Gene Fama, there are still ways to go in terms of behavioral economists, and Fama's point is that it really takes a model to beat a model. So here we've got this model of rational investors. Okay, you've shown anecdotally through various psychology experiments how individuals might not act rationally at a particular point in time. But where is the unifying model? And so that's where it becomes a little bit more of a challenge. And so I think this is where we're going to see perhaps more developments and refinements in terms of some alternative models to the rational investor model.
And that would be interesting, because one thing, as again a non-academic person, I find very interesting is it took this long for behavioral sciences to get it, up and running. Because I mean, if you read Adam Smith's Theory of Moral Sentiments, the book that he wrote before Wealth of Nations, he sort of alluded to behavioral side himself. I think he talked something about the struggle between passion and impartial spectator, if I remember the words correctly. And he sort of recognized that there is a behavioral element that's beyond rational. And so I always found it fascinating that while like the mathematical models in economics and finance really took off with the behavioral side, it took a couple of psychologists to bring economists back to the rational, the behavioral side. Absolutely. So obviously going through all these individuals, they have different models, some very interesting. At the end of the book, you sort of put everything together. So without giving everything away, like I said, we want people to read the book. In your opinion, what is Professor Steve Foerster's perfect portfolio?
So let me answer that by talking a little bit about the last chapter, and I don't mind giving away some of the punchlines. I think there's a lot your listeners and viewers can get from the book and our website as well, in pursuitoftheportfolio.com. But our challenge when we had finished interviewing these 10 luminaries was to try to make sense of what we heard and to try to synthesize it. And so what we came up with was what we call the 3 Ps approach to investing. And that's principles, process, and path. So let me take you through where these 3 Ps lead us to ultimately to the perfect portfolio. So the principles are really a checklist that all investors should be able to follow. Number one, you have to determine how much expertise you have in terms of financial planning. How much time and energy do you want to put into this? And that should lead you to whether you are comfortable in terms of do-it-yourself, or whether you should rely on a financial advisor. The second point on the checklist, our second principle, is to determine what your current and your future needs are going to be. And so you really start at the end, start with your life goals. You want to translate them into financial goals and determine what your future needs are going to be. Number three is finding your financial risk comfort zone. How much can you truly lose in terms of your savings before you begin to freak out? Number four is to develop an investment philosophy. And this is where our book doesn't tell you this is the philosophy you should have, but it challenges you to think about, are you in, for example, Jay Fama's camp? And are you convinced that by and large markets are efficient? Or are you in Bob Schiller's camp and the behavioralists who think that not all investors are rational? The fifth point on the checklist is to come up with a list of all the assets that you're willing to hold. It could be stocks, bonds, derivatives, commodities, real estate, and also what are you not prepared to hold. So basically there we're thinking in terms of Sharpe's overall market portfolio, and perhaps there's a subset of potential investments that you want to focus on. Number six is to get a good sense of what the current investment environment is relative to historical norms. Is it perhaps that we're in a recessionary time or an expansionary phase? And the final principle is to avoid obvious investing mistakes. And some of these mistakes can be incurring higher fees than you need to, turning your portfolio over. Sometimes we think that we are better investors than we are, and so we tend to trade excessively, and that costs us. So those are the principles, and those are universal. That's a checklist for everybody. Now, yeah.
Sorry, no, please go ahead.
Yeah, so now comes to the second part, which is our process, and so this is where we come up with it's basically a very short self-assessment, and these are some extremes, and it could certainly be much more refined. But the process is where each individual and each environment is different, and so you need to determine who you are and in what environment are you investing in. So we choose four characteristics. One is your degree of risk aversion. And so by that, we give two extremes. Are you a dove who's very risk averse, or are you a hawk who's very risk seeking? The second one is the magnitude of your current and your future wealth and your earnings power. Are you a Midas and everything you touch turns to gold, or are you a Peña? And actually, there's a Greek goddess of poverty that we found out about. Who knew that there was a Greek god to poverty? So are you a Midas or are you a Peña? The third one is understanding the magnitude of your current and future needs. So are you a big spender like the Great Gatsby, or are you a miser like Scrooge? And finally, what kind of environment are we in? Are we in an expansion or a recession? So based on those four factors and just using this dichotomy of two within each, that gives us 16 different unique archetypes that we describe. And that leads to the third part. Once you know where you fit, that will present you with a path. And that path will suggest what kind of asset mix you should have. Should it be heavily invested in equities or in fixed income? And is there some action that you should take, such as seeking out and getting some help from a financial advisor? So the bottom line throughout all of this is that each individual is unique, and so there isn't one perfect portfolio. But if you go through these principles and the procedure and the path, that should lead you to what your perfect portfolio is.
Wonderful. And when you said about finance, if we think we're better investors than others, it's sort of like the analogy I can come up with is like driving. You never meet a self-identified below average or average driver, right?
That's correct.
Everyone's a pretty good driver. So, yeah, sometimes, like you said, we think we're Mr. Spock, but we're more Homer Simpson than we'd like to admit. Um, so let's say I go through the checklist. I, you know, write down my principles. I go through the process, figure out a path. So if let's say I want to do it myself, what are some of the things a do-it-yourself investor should be mindful of in terms of what are some of the macro or even micro elements they should try and adopt or they should look out for? And what are some of the good learning resources for a DIY investor?
Sure. So I would take all of this these three P's that I just described, and I would narrow it down to the following. There are only four levers that any investors has available. One is the size of your financial goals. That's up to you, and that's something that you could change. You might have big dreams in terms of what your retirement is going to look like, or owning a second property, or other things. And so that has to be your starting point. And once you've gone through this process, again, that lever, you can ramp that up or you can ramp that down. The second lever that is under your control is how much you're willing and able to regularly contribute by way of savings and investing. And you might not be able to have it all. You might have to make some big sacrifices today in order to achieve your future goals. But again, that's a lever that you can dial up or you can dial down, depending on how much you want to defer your current consumption in favor of future consumption. The third lever is how much time you have to achieve your goals. You might want to retire at age 55 or maybe age 35, which might be 5 years away from now. How realistic is that given the size of your financial goals? And so this is where, well, perhaps you might want to defer buying that second property until you have greater savings. You might even defer what your retirement is going to be if you have that option. And finally, the fourth lever is the expected return that you're going to get on your savings and investing. And really, that should come after you figured out, one, the size of your financial goals, two, how much you're willing to contribute to your savings and investing, and three, the length of time that you have. So, for example, suppose your financial goals are such that in 10 years, you're going to need $1 million. And currently, you have $800,000. So you can work out what kind of expected return you're going to need on that $800,000 plus any additional savings between now and that target date. And that expected return should then drive what kind of asset allocation you as an individual should have, and therefore what your perfect portfolio is going to be. So let's suppose it's a 7% expected return that you're going to need. Perhaps then your portfolio might be something like 60% invested in equities and 40% invested in bonds in a very simple model. If it turns out that expected return that you need is going to be 20%, then you better revisit numbers 1, 2, and 3, because chances are there isn't going to be an investment that's going to give you that 20% over the next 10 years. So back to macro and micro questions you were asking about. If you are using index funds, ETFs, then you really shouldn't have to worry about micro issues. Should I invest in this particular stock versus that particular bank stock? But rather than you can just invest in its index fund. From a macro perspective, again, this really depends on to the extent that you're going to be an active or passive investor. If you're going to be a passive investor and simply have a buy and hold strategy, then you don't have to worry about the macro factors either. So it's only to the extent that you aren't going to be simply buying an index fund that you have to worry about micro factors. and only to the extent that you are not going to be buying and holding that you have to worry about some of these macro factors.
Wonderful. So as we come towards the end of our podcast, the theme of our podcast is the future of. So we've gone through some of its history. We've seen that, we've talked about some developments in finance. What do you think is the future of investing?
Sure. There's a number of visions in terms of what the future investing is going to look like. And just looking back over the last 50, 70 years, it's incredible how far we've come in that relatively short period of time. I think we will continue to see this trend toward passive investing, primarily driven by lower cost investment opportunities. I think we will see more and more investors relying on so-called robo advisors. And I think that we will see improvements in terms of artificial intelligence that will help with this robo advising, and will also help to save us from ourselves, save us from our own emotions. And that's where I think a huge potential benefit, not only from robo-advisors, but also perhaps supplemented with real people and financial advisors who can help us in terms of the emotional tendencies that we might have. I think we're going to see more investable products. If we go back to the previous century, really the only mainstream investments were stocks and bonds. It's really evolved where so-called alternative investments, alternative to these mainstream stocks and bonds, have become more mainstream in themselves. Things like investing in real estate and investing in commodities. But even real estate is an interesting one because it's not really a liquid investment. Yes, there are REITs, which are real estate investment trusts, but don't have the broad appeal to all aspects of real estate. And actually, Bob Shiller was instrumental in trying to get off the ground a traded product that was going to make real estate more liquid. And unfortunately, the excitement wasn't quite there yet. And so I think that's something that we might see being revisited. I think there will be more opportunities for other investments that will provide additional diversification. And I think the verdict is still out in terms of cryptocurrencies as an asset class. I don't believe that currently cryptocurrencies are an asset class. And I think it will take time to really have some form of cryptocurrencies that will be accepted as a true store of value. Just like it took really centuries for gold to be accepted as a store of value. One thing you asked about that I just wanted to circle back to in terms of resources. On our website for our book, we do provide quite a number of resources, many books by the luminaries that we interviewed. So I think your readers and viewers might want to check that out and see if any of it might interest them.
Absolutely. And we'll leave the description for the website as well as a link to your book in our description, both on YouTube as well as audio. So thank you very much, Professor Foerster. This was a very fun conversation. And lastly, something we do with all our guests, obviously we're living in pandemic, but, so we have a little bit more time on our hands. We're thankfully getting out of it. But any movie that you've seen that you would recommend to our listeners or viewers, or even a book that you've read besides your own?
Sure. So a movie that I enjoyed also is a book, The Big Short, based on a book by Michael Lewis, who's a fantastic writer. And many of your viewers and listeners might recognize it as a story based on actual events around the 2007-2009 financial crisis, focusing on a few individuals who were betting against real estate around the time of the financial crisis. And what I like about it, and I think what's relevant, is that it highlights a couple of important investment considerations. One, while I think my personal tendencies are more toward efficient markets, there are some times when the market overall and the consensus sometimes gets it wrong. And so that's a good example of markets getting it wrong. The other big takeaway for me is how hard it is to be an investment controller. It's not an easy thing. As far as a book, I would highly recommend a book by my co-author Andrew Lowe, and that's Adaptive Markets. It's an award-winning book that goes beyond finance and investing, and it draws on psychology, evolutionary biology, neuroscience, AI, and other fields. And what Andrew does is he comes up with what he calls the adaptive markets hypothesis, which is a model that he created that shows that the theory of efficient markets isn't necessarily wrong, but it's not complete. And so we need to take into account all these other fields to really put into place a new model that is more dynamic. So it's a great read and some great stories that.
Wonderful, and we'll leave a description for those as well. So thank you very much, Professor Foerster, for your time. We really appreciate this, and hopefully we have you back on the show in the near future. But have yourself a great day. Thank you.
Perfect. Thanks very much.